Hello and welcome to Options in Plain English. Today we're going to continue talking about the most important strategies and their risk profiles. Today we're going to talk about selling a put or the short put strategy. We're going to start by comparing this strategy to a strategy that we've already talked about, which is the long put. So buying a put, on the top we have buying a put, and on the bottom we have this new one we're going to talk about here, which is selling a put shorting a put. As you can see here, just by quickly looking at it, you can see that the long put, you buy the put, the price is here, and you buy the put, and then you profit if the price starts going lower. The profits are unlimited or all the way to zero, and you lose only what you put in. So basically, whatever it is that you paid for the put is your max loss. Now, if we look at the short put, it's a very similar strategy, but instead of buying a put, now you're selling a put. So you have it right here because it's on the bottom of the axis. So you have the price here, and you sell a put, and then if it starts going lower, then you start losing money. So in a sense, it's the opposite of the long put strategy. You can see that you can only make a certain amount of money, but not more than that. So the profits are limited and the losses are unlimited or very high because you can lose all the way to zero. Same as with a stock. So if we start thinking about this, the long put strategy is a bearish one, and the short put strategy is a bullish one. The long put has limited risk and unlimited profitability, and the short put has very high risk but limited profitability. And the reason why it says here very high risk instead of unlimited is because at least it's bound by zero, so it can't go lower than zero. But it's very high. It's basically the price going all the way to zero. So very high. Now, the cost of the put is the buying power reduction in our account. So in order for us to put this on, you would have to pay for the put, and that would be your only cost. Now, that put could go very high, or it could stay here, and it could be a loss, but it's a limited loss. If this strategy is a bearish strategy, and as you can tell, it doesn't matter how high it goes, you can only lose what you put in. Unlike that, the short put, you have a buying power reduction, which is not as straightforward as for a long put. For a short put, if you have a cash account or if you have a margin account that doesn't have the highest level of approval to trade options, which in most cases is level 4, then you would need to have the money for the max loss, and that's what this strategy is going to be requiring you to have in your account. So, for example, if you were short the $100 put, one contract covering 100 shares, you would need to have the $10,000. So 100 times 100, which is the max loss that you could take here, because it can go to zero. So a single put is going to require you to have $10,000 to carry that position. We're going to go into more details about this, but just for so far, know that it is not as straightforward as being long a put. The reason why we look at the long put first is because of the fact that you can make a lot of money with a reduced or a very limited amount that you're risking, and it's very simple to understand. The short put is a little bit different, and it has its advantages and disadvantages, of course. And we need to start looking at selling options short so that we can now understand the whole spectrum of positions that we can put on. So later on, we're going to start combining them as well. And you need to understand what a short put is, what a short call is, etc. Now going here, this is what I was mentioning. If you have a cash account and you don't have any margin, but you have sufficient funds in your account, you can sell a put. It's called a cash secured put because it's secured with cash. So what you would do is, for example, if you have $20,000 in your account and you want to sell one put of the $100 strike, then because it's 100 shares, you would need $10,000. So you can put it on, and then your account is going to be taking those $10,000 and putting them aside. You can't use them anymore. That is your buying power reduction, which is the BPR, which is a very important metric when you're trading, and especially when you're trading options. Now, if you have a margin account, which means that you're allowed to borrow money to trade, then there's different approval levels. And in level 1, you're mostly allowed to have cover calls and cash secure puts. And as the levels go higher, you're allowed to put on more complex positions. For example, here you can buy calls and puts and use margin for it. And on level 3, you can use spreads. And level 4 is the highest level, and you can do anything you want. You can even sell the put that we're talking about without having the full amount that you would lose if it goes to zero. So let's take a look at this. So in that case, so for a margin account with the highest approval level, which is allowed to sell uncovered puts, or also people also refer to them as naked puts. So for margin accounts that have the highest approval level, the buying power reduction is going to be different. The buying power reduction, the BPR, is going to be, I'm going to give you an example of a broker. And although most brokers are going to have something that's very similar, they don't have to be exactly the same. They might be more stringent in their requirements or less stringent in their requirements, but most of them follow more or less the same formula to figure out the money that you need in order to start selling puts. So again, margin account, highest level, the BPR would be the highest of, and you need to start doing a formula, 20% of the stock minus the amount that it is out of the money buy plus the value of the option, or 10% of the exercise value plus the value of the option, or $50 per contract plus the value of the options. So in that same example, let's say we have the $100 stock and we sell the $90 put. You would have the 20% of the stock, which would be $2,000 because it's one contract of 100 shares of a stock that's trading at 100. So 10,000, 20% of that is 2,000 minus the amount that it is out of the money buy. So it would be 2,000 minus 500 because it's $5 out of the money times 100 because it's 100 shares per contract, plus the option value. Let's say you sold it at $3. So it's trading currently at $3. The total number here would be 2,000 minus 500, so 1,500, plus 3,000, so 1,800. So to sell that put, you would need to apply the formula, and you would have a requirement of $1,800, so 1,800. Now keep in mind, as the prices start moving, if they move in your favor, you're going to require less in buying power reduction. But if it goes against you, the BPR is going to start growing, and it might get to a point where it becomes a problem because of the your other positions. Because maybe you have you are already with a lot. You already have a lot of positions, and this one particular position, because the BPR is growing, might might make your account a little bit unstable, or something where you start getting nervous because you might run out of cash. In general, being short options, it requires you to have a different mindset where you need to be more careful, and you need to be very mindful of the amount of capital that you have and how much money you're going to put into shorting options. But having said that, it is a profitable strategy. There's traders who do nothing but sell options for a living, and some institutions complement their buying options with also selling options. So it's good for you to know this. So you can take a look here. The whatever is the highest of these three values, you're going to use as a BPR, and at that point, you would know what it takes for you to carry that position. Now let's take a look at this strategy, and let's start analyzing it so that we know what we're talking about. Here you can see the green area here is the profitable area, and the red one is the of course the unprofitable, so the one where you lose money. So this is a bullish position. You have the price over here, and we're gonna analyze the selling and out of the money put, but it works the same if you sell it at the money or even in the money. But in this case, just to make things a little bit clearer, we're going to talk about a selling and out of the money put. So you sell this put, which is here represented by the circle with a P, and it's on the bottom of the axis, so you can tell that it's a short put. Okay, you sell it for a certain amount, and then that amount is going to help you extend your break even. So your break even is going to be here, because if you sell the put and you stay in this area, then it expires, then you don't need to do anything. You just sold something that you don't need to buy back, because the value is going to be zero. So at that point, you would be released from your obligations, and you would keep the whole credit that you got initially. So you sell the put, you get a credit, that's your max profit. This dashed line represents the change in time. So when you start, you don't have a profit, of course, but as time starts passing, if nothing happens, then this line is going to start approaching the expiration line, and that's going to make it very profitable for you if there is nothing. So if nothing is happening, so this strategy is very is well suited for environments where you think that a certain underlying is not going to have a violent move, especially to the downside. So in a way, with this strategy, what you're doing, instead of betting on something happening, you're actually betting on something not happening. So your price can stay here, or it can go a little bit lower or much higher, and you're going to be making money in both situations. Or if it stays the same, if it goes higher by a lot, and if it goes a little bit lower, you're going to make money. You only lose money if there's a violent move to the downside or a large move to the downside. So this is one of the reasons why traders use this strategy, because it gives you a wider profitable area, even though the amount that you're going to be making is limited. It's only the initial credit. So once it starts going in the money, then you're still protected by the credit that you got. So you start losing money, but you're only even at a point where the break even is equal to the strike where you have your put minus the credit that you got for it. So K minus P is going to go to the break even. So you have the max loss, which is equal to the strike K minus P, which is the amount that you got initially when you sold it, so the credit, which would put you at the break even. And this happens if the underlying goes to zero. Okay, the max profit is only the credit that you got. That's the max profit. And you're going to make money if the underlying expires above the break even, and you're going to lose money if it expires below the break even. However, most traders buy and sell their options prior to expiration. So you probably sell it when you have some profit. So you can specify a profit target and then get out when you feel that you've made enough money for that trade. Now let's take a look at an example so that we can better understand how this all works. Let's say that you have a stock that's trading at $150, so it's right there, and you sell the strike price of $140 put for a credit of $8. Okay, so that would give you a break even of 132. So the 140 minus the money that you already got, the credit of $8. So 140 minus 8 would take you to 132, which would be your break even. Now, what does this mean if we start analyzing this? Well, remember, time passing with no price movement is beneficial to this strategy. So if time starts passing, you start making money, this dashed line starts approaching the solid line, then you're going to start making money, and you can, if it reaches your profit target, you just close it. So you open this position with a what's called a sell to open transaction, and then you close it with a buy to close transaction. So sell to open and then buy to close. Okay. If we continue analyzing this, again, prior to expiration, you can buy to close, or you can roll it and you can adjust it. We haven't talked about rolling or adjusting, but it's there are strategies to extend time or to adjust the strikes of an existing position. We're going to talk about that later. But here, if it expires out of the money or at the money, you're going to keep the full profit, because at that point the put is worthless with no more time to go. If it expires in the money, then what's going to happen is your stock is going to be assigned, so you're going to purchase it at the strike price. So let's say, for example, in this case it expires at 120. Well, at that point you're going to be put the stock at $140. But because you got $8, okay, so your real cost is going to be $132. And if you're put the stock at 120, well, you have a loss of $12 between 132 and 120. And of course, $10 multiplied by 100 shares per contract is going to be $1,200. So one of the main uses of the short put is as a way to buy stock only if it falls to a certain price and to get paid while you're waiting. So let's say, for example, you have the stock at 150 and you feel that you want to get into this stock and you want to buy it, but right now it's too expensive, but you would buy it at 140. That you think is a fair price. Well, if you sell the $140 put, now remember, you need the full amount if it's a cash account, or if you don't have the highest level of approval for trading options, or you need the sufficient funds to cover the BPR. if you are approved for selling uncovered or naked puts in this case. But if you do have that, then you sell the put and you wait. And let's say it never gets to 140. It goes to 160, so you miss the boat. Well, yeah, you missed the boat, but at least you get to keep the premium. So you get to keep the credit that you got for selling the put. So it's a way to, in a way, hedge your potential entrance or entry into a stock. So let's say, for example, you have this, you sold the 140 for $8, and then this stock, $150, goes to 140, then you can actually let this one expire, keep the full profit, and then buy it at $140. So now your real price is $132. So you got it at a discount. So that's how shorting a put can be useful for a trader that's actually more interested in acquiring stock. So as you can see, it's a very versatile instrument because you can use it to profit on the upside, but also you can use it to acquire stock at a discount. Of course, if you were wrong in your assessment and it goes lower by a lot, then you're going to be having some losses, but this is the normal risk that you have when you're in the stock market or in the options market. Now let's, what we're going to do is we're going to take a look at a real example, a quick example of shorting a put. And so you can see it on the platform, and that would be a little bit clearer as to what we mean when we start talking about selling a put and how the profits are made when you sell a put. So now we're on the trading platform, and we're going to take a look at Walmart. WMT is the ticker symbol. I've already opened up the May 2020 expiration. And you can take a look at all the options here. It's trading at $128.30. So this is the at the money roughly, 128. You can take a look at the puts and the calls. So what we're going to do here is very simple. We're going to be selling a put, but we're going to do it twice, because once we're going to do it in a cash account, and then we're going to do it in a margin account so that you can see the difference in buying power reduction. So I'm going to be switching here to a cash account. Okay. So what I'm going to do is I'm going to go to the 34 Delta put, which is this one. So now you know about Delta. So I can just refer to it by going to the Delta 34 Delta put, which is the 125 strike put. And it's this one. And what I'm going to do is I'm going to sell it. So I sell it. I'm selling one contract of the May 2020 125 put for $183. So $183 because every contract is 100 shares. And now we're going to analyze here what we're going to have in our transaction here. So it says right here that the max loss is $12,317. Why? Because it's the 125 strike, so you can only lose the amount from here to zero, so 12,500. But we are receiving $183, so that helps offset the loss. This is why it's 12,000. But you can see here that the buying power effect is $12,317. So you need to have this money prior to putting on this position if you're in a cash account or you are in a margin account that doesn't have the approval level for naked puts or naked calls or anything uncovered. So you put it on, and something that we already seen. This is the transaction, and this is where the price is. It can stay here, go a little bit lower, or it can go much higher. And the purple line is representing the profit and loss now. The blue line is representing the profit and loss at expiration. Very simple. This we already saw. Just this is a neutral to a bullish position because it can stay here and you're going to start making money as time passes. So you can see here, little by little, it starts approaching the expiration line. So it can stay the same, it can go higher, it can go a little bit lower, and at expiration, it's still going to make money. Now, this is simple, but now we're going to go back and we're going to do the same thing in a margin account. So I'm going to delete this transaction. I'm going to do it again. And you can see here, now we have the exact same thing, but instead the max loss is still $12,000, 12,317. But the buying power effect now is $2,235. Why? Because it's applying the formula that we talked about. It's just around 20% of the total value of the contract. So in this case, you would need $2,235 in your account, and then you can put on this trade, and you're gonna receive $183 as a credit. You get to keep that credit no matter what, and then once you close it, and if you're able to close it for nothing because it expired out of the money or something like that, you get to keep the whole credit. Otherwise, you close it for a certain amount. So you go and do a buy to close, and then that's where it ends, and then you have your profit or your loss. So I hope this was clear, and I hope this is going to be very useful for you. From this point on, we're going to start looking at not only buying options, but also selling options and combinations thereof, and also combinations with options and stocks. So it's important that these concepts are really clear, because we're going to take it from here, and we're going to go into things that are a little bit more complex and more involved in terms of calculations, etc. Thank you very much for your attention, and goodbye.